In America, retirement planning often starts with a confusing list of letters and numbers: 401k, Roth IRA, traditional IRA. They sound technical, and many people mistake them for complicated investment products that require a finance degree to understand. Before we clear that up, a quick note. This video is for educational purposes only. It is not personal, financial, tax, or investment advice. These accounts simply answer two structural questions for the IRS. Where's the money coming from, and when do you pay taxes on it? The entire U.S. retirement system is built across a major divide. The system splits your paycheck into two possible paths: money routed automatically through a workplace benefit, or money you route yourself through an individual bank account. Today, we are going to look at the 2026 IRS rules to demystify these two core pillars. By the end, you'll be able to confidently map your money to your current stage of life. Mastering the distinction between these accounts establishes the baseline for every financial decision you will make in the American retirement system. Standard financial advice often assumes you will work a continuous, unbroken 40-year corporate career. The reality for many U.S. women looks very different. Career timelines are frequently nonlinear, involving pivots to freelance work, part-time transitions, or stepping away completely for caregiving responsibilities. During these transitions, society often treats women's time like infinite sand. But when it comes to financial planning, your time must be treated like diamonds. Devaluing your own time to manage domestic transitions directly impacts your long-term financial power. When your employment timeline shifts, your access to specific retirement accounts shifts with it. If you don't know the rules, stepping away from a traditional job can unintentionally freeze your wealth-building years. Navigating this system requires a dynamic approach. You need to know which account lever to pull when your employment status or household reality changes. We start with the 401k. This is strictly a workplace account. You cannot open one on your own. It requires active employment with a sponsoring company. It functions through automatic payroll deductions. You choose a percentage, and the money is pulled from your gross pay before it reaches your personal bank account. This chart shows the primary advantage: sheer volume. The 2026 contribution limit scales up to $24,500. With a traditional 401k, you get an immediate pre-tax advantage. Your contributions act as a deduction against your federally taxable income for the current year. The trade-off is that this money grows tax-deferred. The IRS will eventually tax your withdrawals as ordinary income in retirement. And by age 73, the government mandates required minimum distributions, forcing you to pull money out and pay those taxes. The 401k is the ultimate automated volume builder, but it tethers your primary wealth-building tool to your employer and leaves future withdrawals at the mercy of unknown tax rates. There is one factor that makes the 401k an absolute priority for most workers: the employer match. This is the closest thing to free money in the U.S. financial system. Look at this sample benefits document. A common formula is a dollar-for-dollar match up to the first 3% of your salary. If you deposit 3%, your company deposit another 3% right beside it, instantly doubling your investment. The catch is the vesting schedule. Vesting is the time your employer requires you to remain before you fully own their matching contributions. If you leave your job before that vesting period ends, you forfeit the unvested portion of the employer match. You always keep your own contributions, but the company money returns to the employer. Failing to contribute at least enough to capture your full employer match means you are leaving a portion of your total compensation package on the table. On the other side of the system is the Roth IRA, or individual retirement account. You open this entirely on your own through a brokerage, completely independent of any employer. The tax mechanics run in reverse. Roth IRAs are funded with after-tax dollars. The money going in has already been taxed by the government. Because you pay the tax up front, your investments grow tax-free. When you reach retirement, your qualified withdrawals, including decades of compound growth, are completely tax-free. This visual compares the contribution limits. Because the tax advantage is so strong, the IRS restricts the volume. In 2026, the maximum you can put into a Roth IRA is $7,500. The IRS also enforces strict income phase-out limits based on your modified adjusted gross income. In 2026, single filers earning $153,000 or higher, or joint filers earning $242,000 or higher, lose the ability to contribute the full amount directly. The Roth IRA offers ultimate tax freedom and total individual control, but it requires meticulous attention to lower contribution caps and shifting income limits. This brings us back to the reality of career pauses. If you step away from the workforce to manage caregiving responsibilities, you instantly lose access to active 401k contributions and any potential employer matches. The structural risk here is severe. A gap in employment can completely stall your individual retirement timeline, costing you crucial years of compound growth. This is where a spousal IRA functions as a critical bridge. If you file taxes jointly, a working partner can contribute to an individual IRA on behalf of a non-working partner out of the household income. Career pauses demand a shift in your financial mechanics. By moving from workplace dependency to individual solutions, you ensure your financial power doesn't freeze just because your career does. 401ks and Roth IRAs function as complementary levers, optimized for a specific phase of your career. This flowchart maps out two common scenarios. Path A is for women in their peak corporate earning years, with access to a strong employer match. Your primary directive here is capturing your full compensation by grabbing that match and using the high contribution limits to aggressively lower your current tax burden. Path B is for women managing a career transition, a freelance pivot, or a caregiving role. Your primary directive in this phase is utilizing after-tax money to secure a permanent, tax-free bucket under your total individual control, ensuring your savings rate doesn't drop to zero. There is no single right account in a vacuum. The correct choice depends entirely on your current career status, your household income, and your tax bracket. To summarize the divide, one account is tied to your paycheck and delays taxes, while the other is tied to your individual bank account and eliminates taxes in the future. Your first action step is simple. Pull up your current workplace benefits packet. Explicitly locate the matching formula and check the vesting rules so you know exactly what is required to keep that money. Your second action step is for the individual route. Verify your current household income against the 2026 IRS eligibility limits to see if a Roth IRA is an open path for you this year. Because tax rules shift frequently, consulting a financial or tax professional is the best way to apply these guidelines to your household. By understanding these structural differences, you no longer have to react to confusing financial jargon. You can start architecting a durable, independent retirement timeline on your own terms.